What if you could retire years earlier than you expect, without chasing hot stocks or fancy schemes? The answer is simple, boringly reliable. Index funds, a plan you actually follow, and time on your side. Hi, I'm sharing a practical way to retire early using index funds. This isn't a hype video, just a straightforward plan you can start today, with simple rules, real numbers, and a timeline you can track. First, you need a clear goal that fits your life. Second, you need to automate saving so the plan sticks. Index funds give you broad market exposure, low costs, and reliable growth over years. They don't require picking a winner each quarter, which is why they stay simple and tough to mess up. Think of them as planting a forest instead of babysitting a single tree. The 25x rule is a simple target you can repeat to stay focused. It means your annual expenses in retirement multiplied by 25 gives you a rough nest egg. If your plans are honest, this number doesn't need magical moves or shortcuts. If you expect to spend $40,000 a year in today's dollars, 40,000 times 25 is about $1,000. That's the rough target most people use for planning, and it keeps the math honest. You don't need to be rich to reach it, you just need to start and stay steady. Your time horizon matters a lot. The more years you have before retirement, the more compounding can work for you, so you don't have to save as aggressively every single year to reach the target. Time is your quiet partner in this plan. Let's build a practical plan you can actually follow. It starts with knowing your income, your expenses, and your tolerance for risk. When you know those three things, the plan becomes a system you can trust. Step 1 is to build an emergency fund. That fund stays in cash and acts like a landing pad for life surprises. It keeps you from pulling money out of your investments at a bad time. Step 2 is to open the tax-advantaged accounts you have access to, like a 401k or an IRA. If you're self-employed, look for a solo 401k or a SEP IRA. These accounts give you tax advantages that help your money grow faster. Step 3 is to choose your core investment vehicle. A single global index fund can cover most of your stock exposure. It's the backbone of your retirement plan. You can choose a fund like Total World Stock or an equivalent ETF. The idea is to own almost the whole world stock market in one low-cost place. That makes diversification simple and practical. Step 4 is to add a bond or bond-like fund to reduce risk. A broad bond index fund helps you smooth returns and protect you when stocks wobble. You don't need to chase fancy bonds to balance the portfolio. An 80-20 split is common for younger people. That means 80% stocks and 20% bonds, which gives growth with some stability. It's a starting point you can adjust as you age. As you get closer to retirement, you can shift toward 60-40 or even 50-50. The glide path lowers risk while preserving gains from the stock market. The idea is to trade some growth for more safety as the horizon shrinks. Automate your savings so that money goes into your chosen funds every month without you thinking about it. Automation beats willpower for sure. It turns intention into action without relying on mood or motivation. When you get a raise or a bonus, increase your contribution. A rising savings rate keeps up with your growing income and inflation. Small changes here compound over years, just like your investments. Track your expenses for a few months and cut what you don't truly need. Small cuts add up when you're saving a large portion of your income. The aim is to free up money that would otherwise vanish into daily use. Keep your costs low. Choose funds with expense ratios under 0.2% if possible, and avoid funds with hidden fees. Fees are sneaky, and they eat you alive over decades. Next, keep things simple. A global stock fund plus a bond fund covers most of what you need, and you won't be juggling dozens of funds. Simple can beat complexity when it comes to long horizons. Rebalancing once or twice a year helps your plan stay on track. It means selling a little winner and buying more of the lagging parts to keep the mix. This is not market timing, just keeping the balance you started with. What happens when markets fall? Keep investing. The plan works best when you stay in the market long enough for the recovery to lift your balance. Time tends to smooth out the rough years. Don't try to time the bottom. Dollar cost averaging lets you buy more shares when prices drop and fewer when they rise in a steady rhythm. This reduces the chance of a big mistake and keeps you moving forward. Your spending matters as much as your investing. If you consume less than you earn, you'll reach your target faster. Your lifestyle choices are part of the plan, not just the savings account. Think about frugality as a practice, not a punishment. It shows up in small choices like coffee habits, housing, and transportation. Small, consistent decisions add up to big results over time. Consider a side income if your day job is slow or uncertain. A simple side project can fund additional investments without touching your main budget. It also gives you a backup plan that your future self will thank you for. Your housing costs are a big lever. If you can live more cheaply now, you'll reach your goal faster and keep more of your money working for you. A comfortable, sustainable pace beats rushing into risky moves just to look successful. Automation deserves a second mention. Set up automatic transfers, automatic rebalances, and automatic annual reviews of your plan. The system runs in the background so you don't have to start from scratch every year. Review your plan at least once a year. Markets change, income changes, and your goals can evolve, so your plan should adapt. A yearly tune-up keeps your path clear. Let me walk through a practical example so you can see how the numbers fit together. Real life isn't a straight line, but a scenario helps you understand what's possible with steady effort. Imagine you're 25, earning $60,000 a year after tax, and you want to retire at 50 with $40,000 a year in today's dollars. That's a genuine goal for many people who don't want to wait until their 60s. You decide to save $25,000 a year into a global index fund with an 80-20 allocation in your 20s and early 30s. We'll assume 7% annual returns before inflation. This combination balances growth with some protection against risk. Using the math for compound growth, those contributions grow to about 1.6 million by age 50. That's enough for a 40,000 annual withdrawal under the 25x rule. It's not magic, just math and consistency. Where does that number come from? Because you're buying growth for 25 years? Compounding does most of the work. Your earnings snowball beyond your annual savings as time goes on. Of course, real life isn't a smooth line. Inflation makes the 40,000 feel larger over time, so you'll want to adjust estimates as you go. You can run fresh numbers every few years to stay honest with yourself. If you started later, you'd need higher savings, or a couple of extra years. The math still works. You just accelerate the plan or extend the horizon a little. Maybe you can increase your savings by $5,000 or $10,000 a year, or take on a side project that fits your skills. Small shifts here and there can push your plan into reach without turning your life upside down. You can still aim for a 50-50 split as you near retirement, to minimize risk while you enjoy the upside of stocks. The idea is a gentle shift toward safety without losing the ground you've gained. Another important piece is taxes. Put as much as you can into tax-advantaged accounts first, then in taxable accounts with low fees. Tax efficiency compounds too, so plan with your calendar in mind. Once you retire, you switch to a withdrawal plan that starts with the 4% rule and adjusts for inflation and taxes. It gives you a framework to live on your investments without overspending early. Be prepared for changes in your life, health costs, and healthcare policy. A cushion beyond your nest egg can reduce stress in retirement. You won't predict every twist, but you can prepare for the big ones. Common mistakes pop up fast. Spending too much early in the plan, or chasing a perfect fund, or ignoring fees can derail your progress. The simplest path is often the steadiest one. Another trap is letting your guard down during a market rally. Stay disciplined, keep investing, and don't end up living on credit. Your future self will thank you for staying the course. People often forget to plan for healthcare and long-term care, which can be a big expense in later years. Build a contingency into your plan, even if it means delaying some goals. You don't have to solve everything today, just plan for the big costs. Your plan should be actionable today, not tomorrow. Start with a low-cost, broad index fund, set up automatic contributions, and write down your retirement number. Small steps now compound into a solid future. Now tell me in the comments what numbers you're aiming for and how you'll start. If this helped, please like, subscribe, and drop a comment.